All
Go
right.
ahead.
Welcome, welcome. So Eddie and I from Elevation are here with Leo and Ephraim, our lenders at Odette Mortgage Group, omglenders.com,
OMG.
for an update on the market. There's been a lot of news this week, so we're curious to see your standpoint and give us a little bit of your insight today.
Thanks, Monica and
Awesome.
Eddie. Thanks for having us again.
Awesome. Well, that on everybody's mind is the fact that yesterday the Feds turned around and increased the I forget the official term for it, the interbank rate or whatever that rate is, that by 3/4 of a basis point. What what does that mean for mortgages? Do they suddenly just shoot up today, or what happened?
Good question. So what the Fed hiked yesterday was the Fed funds rate. They hiked it 75 basis points. This is the fourth consecutive 75 basis point rate hike in a row. What this does is it directly increases the rates on short-term consumer debt, like credit cards, auto loans, student loans. It does not necessarily mean mortgage rates move higher. Mortgage rates are based on bond prices. And when bond prices go up, mortgage rates come down. And so for jumbo loans, that's the 10-year treasury. And for conforming loans, it's Fannie Mae mortgage bonds. So the question, is what will the Fed rate hikes impact be on the bond market? And if the bond market believes that these Fed rate hikes are going to be successful in bringing inflation down, this will actually be good for mortgage rates. So that's really the relationship between the Fed funds rate and mortgage rate.
So does that mean with the expectation, because everybody was telling me that the Feds were going to increase by 3/4 of a basis point yesterday. It seems like everybody knew it before the Fed even did it. So was it like, was it already baked into where we are on rates with mortgages at the moment?
It absolutely was 100%. There are probability, you can take betting odds on what the Fed's going to do. And it was as close to 100% probability as you could get that the Fed was going to hike the 75 basis points. So mortgage rates today haven't really moved much at all, pretty flat compared to yesterday. And in fact, over the last couple of weeks, mortgage rates have actually improved a hair. Wow. And we're seeing just the inflation data, although it's not coming down as quickly as the Fed would like to see, it is slowly coming down. And, like all data, there's always several ways you can slice it. And we're seeing these CPI inflation data numbers where they're high but coming down, and they're in the 8s. 8.2 was the last one. Now, it's important to remind folks that that's year-over-year data. So this isn't relative to October of 2021. And if you actually look at inflation over just the last 3 or 4 CPI reports, it actually looks pretty flat. So if you look at inflation just really over the last couple of months, it's essentially close to zero. So what that really the story is, rates, cost of everything shot up, and now it's really plateaued. And so even if prices really just remained exactly where they were, as we move further into next year, you would see the CPI and inflation numbers naturally just come down because the year-over-year numbers would be relative to a year ago. The bond market would see that inflation data as coming down, which is a good thing, and that's good for mortgage rates.
Awesome. So, like, a lot of people are asking us right now, how long is all this going to last? Okay, I understand I'm going to get an opportunity to refi, but everybody has a crystal ball. Somebody says it's 12 months, 24 months, 36 months. I've heard people saying, hey, buckle down, 2025, 2026. Like, first off, it feels like, maybe ARMs are the new product to do. And kind of what are your thoughts on what's going to happen there?
Good question. So I think just to kind of demystify some of what people are going to be hearing in media over the weeks ahead and separate, okay, Fed funds rate versus mortgage rates. The Fed is kind of said they expect to hike the Fed funds rate another full point. That'll probably happen in the form of 50 basis points in the spring and maybe another 50 basis points sometime later next year. And then they're hoping that they can just kind of wait and see what inflation's doing. And they did say yesterday, Fed Chairman Powell yesterday said he expects rates to have to kind of sit there for some time. The equity markets didn't love that yesterday, and that's why we lost a little bit of ground. But with respect to mortgage rates and ARMs and how people can incorporate all this into planning and how best to structure their mortgage today if they're buying a property, meaning should they look at a 7-year ARM or a 30-year fixed? I can explain the mechanics of what will drive mortgage rates. I'm careful not to get too deep into prognosticating, where I think things will go next year. But there are folks who have more resources and time to focus on that than I do. And for example, the Mortgage Bankers Association of America last week came out and said they predict 30-year fixes will average 5.4% in 2023. So if we believe, if we're confident in that, that tells us that, as we've been talking about, good opportunity to get into property now in a less competitive environment and a good opportunity to drop the rate that you're paying in the near future. And as folks are thinking about ARMs versus 30-year fixes, right now we're seeing 7-year ARMs priced better than the 3s or the 5s, making them a moot point. And the 10s are so close to the 30, it's really just 7-year ARM or a 30-year fixed.
Yeah.
And if you look at a 7-year ARM and you're confident that there will be a chance to refinance in the near future, then, meaning within the next 7 years, then sure, 7-year ARM is a very safe place to go. The only thing you want to avoid is planning to ride those into the adjustable period. And then one other thing that's really important to explain to clients as they fine-tune how to structure their mortgage today is whether or not they pay any points. And right now we're seeing break-even timeframes on points in the 18 to 22 month range. So if someone's planning...
Can you quickly explain what break-even on a point means, just to make sure that everybody gets that?
Yeah. So points have a bit of a stigma, and sometimes you'll hear people say, make sure you don't pay any points.
Yeah, don't pay any points. I don't want to pay any points. Yeah.
The answer is it should always be entirely up to the borrower. And the way pricing any loan works is we plug in all the variables, and each program doesn't just come back with a single rate. It comes back with a rate sheet, and you see the rate and the payment at 0 points, and then you can spend some points to buy the rate down. Points are, if you choose to do points, it's a one-time fee at closing. 1 point is defined as 1% of the loan amount. Points on a primary residence are entirely tax deductible in the year that you close escrow. And so the very simple analysis that we make for clients is, okay, here's the rate and payment at 0 points compared to if you spend some points at closing to buy the rate down, how much did that cost you at closing versus how much did it save you in monthly interest? And how many months of having that interest savings to recoup the point? And right now, those break-even timeframes are 18 to 22 months or so. So yes, you'll pay a bit more at closing, but then you'll have a lower monthly payment. And if you end up holding the mortgage beyond that break-even timeframe, then the lower long-term cost of ownership would be to spend some points. So,
and would that, if you're getting a tax deduction on the cost of the point, is that actual time to savings probably earlier than calculated, because there is technically that point is going to be cheaper because you'll pay less tax, right?
You're exactly right. Very good point. Yes, there is a before and after tax calculation there. And we can't get into giving tax advice because we're not CPAs, but we can talk to clients about the questions that they should ask their CPA and just generally talking about the tax code. But you're exactly right. Based on an individual's tax bracket, you can make an estimation for how much of those points they spend they would get back. And that, of course, would very much shorten the break-even time frame.
And then, so the Fed meets every month, 12 times a year. So the next meeting is December.
Yeah.
What is the prediction that this, half a basis point is a nothing burger for the Christmas December meeting, and then maybe something new in the new year, or what's the thought there?
The expectation, I think what most likely will happen is the Fed will pause and we'll see the next rate hike in the spring. The old rule of thumb has always been that it takes anywhere from 6 to 9 months to see these Fed rate hikes cycle through the economy and impact consumer behavior.
Okay.
And so, what the Fed also acknowledged yesterday is, while the Fed funds rate now at 4% historically is not that high, but for context, what they have done, which is they've done these last 4 consecutive rate hikes in a very short period of time, where we're really probably just starting to see the impact of that first 75 basis point rate hike. So the Fed kind of acknowledged they needed to move decisively with these Fed funds hikes to fight inflation, but now they need to pause for, they didn't use the word pause, but they really need to see what the impacts will be before they continue hiking. And I think we'll probably see something early next year that'll be less than 75 basis points.
Mm-hmm. So they kind of have to let it simmer, and in December dip their finger in and see if it's tasting right. So
that's exactly right.
Yeah,
it's like cooking.
Good. So this is tremendous, and for a parting comment, please, what do you think is just the number one thing for somebody who is looking to get a mortgage at this moment in time? What's the number one thing they should kind of have in their mind or be thinking about, and how do they find yourself and Leo?
Thank you. Well, I think that I always think that the first thing I would encourage anybody to do is to have the pre-approval and pre-underwrite conversations sooner than later. There's no cost incurred. There's absolutely nothing to be lost and everything to be gained by having the conversation, so that we can cover everything to make sure that clients in the best position possible to write the strongest offer possible. And even though the market is not as hyper competitive as it was earlier last year, there's still a competitive advantage to writing an offer without a financing contingency.
Yeah.
So doing the pre-underwrite, contacting us with enough time to do that. And then a couple of quick notes is reminder that the conforming loan limit is set to increase in the San Francisco Bay Area to $1,073,000 in 2023. Wow. So you're gonna be able to get a loan up to $1,073,000 on a conforming loan amount, which is easier to qualify for in terms of lower down payment, higher debt to income ratios, all of that. However, there is one thing to note about jumbo loans right now, is we are seeing a price inversion where, and this is a historical anomaly, but jumbo rates right now are a hair lower than conforming. So there's kind of pros and cons of the two. That number set to increase 2023. And best place to reach me is email or cell phone, or reach us. My email is Ephraim@omglenders.com. It's EPHRAIM@omglenders.com. Cell phone is 415-297-8514.
Beautiful. And Leo, are you Leo at OMGLenders.com? I've emailed you a bunch of times. I know you are. So
yes,
yeah. And you're not, what's your number?
We work as a team.
And my number is 415-317-4523. And yes, as Ephraim's saying, we very much work as a team, and invite conversations regardless of where people are at in the process, to get them in the best position possible.
Awesome. And just to kind of advance on your point there, Ephraim, with the whole of being pre-underwritten, when you're going in looking for a better price from a seller in this market, going in, being underwritten, having all your pieces in place is going to make that seller more inclined to be like, all right, that's a bona fide buyer. I want to move forward. So in the other market, if you didn't do it, you couldn't compete. And in this market, the seller won't engage with you unless you actually do it. So it's same scenario, but just different reason. So yeah,
exactly.
Awesome. How does anybody find us, Monica?
If anyone's looking for us, they can reach us at elevationrealestate.com. Also, our handle for Instagram is elevationSF. So come follow us there. You'll also have a link to view this video again.
Beautiful. All right. Awesome. Thank you.
Much.
Great to see you guys. Thanks.